All down. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another edition of Current Market Insights. I'm your host Kieran O'Brien, and with me is Mr. Peter O'Malley. Peter.
Kieran, g'day to you.
G'day, my friend, and hello to everyone listening. Peter, it's, as always, we're catching up to talk about property, and I really want to focus today on some comments made by Shane Oliver, who is one of Australia's best regarded economists, I guess you could say, and one of the more accurate guys out there in terms of telling us what is actually happening with the numbers. He has made a pretty big statement, I think, in my mind, calling the end of the property super cycle as being upon us, which is a pretty big call. And I'm referencing really an article from the Herald a couple of days ago where Shane Oliver said that the 30-year property super cycle that has made Australian homes among the most expensive in the world may finally be coming to an end. Now, he says this despite warnings that prices will eventually rebound due to a shortage of houses, something that you have mentioned. He goes on to say, though, that a combination of higher interest rates, record poor affordability, a slowdown in immigration, and the federal government's budget changes to property tax may have finally ended a cycle that has pushed home prices way above fair value. Now, lots of those things we've talked about in isolation, but really this is one of the first economists to comment about all of these as a bigger picture issue having changed or maybe being at a point of change. Our listeners and myself would really love to get your thoughts on, firstly, whether you think he's right, whether he's on the money as to this being the end of the cycle, and then how this compares with other property cycles that you've seen in your time and that others have commented on in recent times, including Jim Chalmers in this article, how this compares to other, I'm not going to call them apocalyptic, but pretty cataclysmic property events in the past.
Yeah, thanks, Kieran. And look, we wouldn't normally have a discussion around an economist's strong views like that unless it was someone of the credibility of Shane Oliver. So they were really interesting comments by Shane Oliver of AMP there to suggest that the super cycle could well be over. And I wouldn't go as far as to say that he's incorrect. I'd put a slightly nuanced point on a few of the points that you've just raised there. Every time I go overseas, I do make an effort to look at property prices and, get a sense of how those prices compare to Australian property prices in US dollars or Australian dollars. So you've got a benchmark. And there's no doubt that there are some countries where property prices are more affordable than Australia, like Japan is one, for example, parts of Japan, not the centre of Tokyo, mind you. If you look at New Zealand until very recently, that was kind of comparative with Australia. When I was in Germany, in Berlin 2 years ago for the Euro Soccers, I was looking in real estate windows there, and I didn't look at those property prices in Berlin and say these are noticeably different or cheaper to Australia. I find myself in the UK regularly, and there's plenty of expensive real estate there. So I personally have never quite bought the notion that Sydney real estate is wildly overpriced compared to its global peers. And that's one of those messages that get carried that no one really questions.
Yeah.
And when I went looking for the comparison on that point, I didn't go into it with confirmation bias or want to have any particular view. I'm just saying, what do the numbers tell me? And when I do go to large global cities, they seem to have similar prices. I put it to anyone to point out another large global city like Sydney that has the desirability levels of Sydney that is noticeably cheaper, and I think you'll be hard-pressed to find that. You look at Singapore, for example, at the moment. You think real estate's cheap in Singapore? Hong Kong?
Yeah. Yeah, well, they're not. I mean, I often wonder where they get this stat, right? I agree with you. It is Sydney property is expensive. There's absolutely no doubt. But, I remember this conversation a couple of years ago with someone, and they had moved to, might have been Denmark or, somewhere like that. And they were saying, you should look in the city in Copenhagen or, look in Paris, anywhere that's desirable. Property is exponentially higher than it is for Sydney. And I've always wondered whether it's a reflection of per capita value of property versus, what the population is, for example, or whether it's based on GDP or some other calculation. But
I think it's probably on wages.
Yeah.
Average wages and average property prices.
Yeah, I mean, maybe it's the multiplier. They say in Sydney it's 17 times, well, floats between, say, 13 and 17 times the annual salary is the expected deposit or whatever it might be. Maybe it is a factor of how people are actually accumulating their deposit to purchase in the first place.
Yeah. So, look, going back to Shane Oliver's comments there, he's given not quite a forecast, but he's looking forward in that comment, yeah?
Yeah.
The super cycle's over, you've seen the best of it, and he may well be right. I found myself in a back and forth with everyone that hates property on social media this week because someone put a post out there saying real estate agents are reporting that the current property market is now worse than the GFC.
Right.
And I responded and just said anyone that says the current property market's worse than the GFC is talking complete rubbish.
Yeah.
Because there's no way that this market that we're in now in 2026, as of August 2026, compares with how tough it was in November and December 2008.
Yeah. Oh, absolutely.
And there was a pile on of people saying you'll be proven wrong, you're joking, and all sorts of vicious things. And a lot of people were jumping to, we'll see what happens at the end of this. And it's like, well, hang on, I'm not saying what's going to happen going forward. The comment was the market right now is worse than it was during the GFC in 2008, and that's just inherently not the case. Now, there are certain markets that have been walloped and impacted more than others at the moment in Sydney, and I think we discussed last week that the markets that outperformed from 2022 to the start of this year, such as Northern Beaches, Western Sydney, North Wollongong, the Shire, are now probably suffering a greater correction than what the Inner West is because the Inner West didn't rise as much as those markets in the last few years, therefore it's not correcting as much. So the market's very segmented at the moment, where in Sydney it's now easier again to sell a property for $800,000 than it is a house for $8 million.
Yeah.
Regular listeners of our podcast, Kieran, will remember over the last few years we've been saying it's easier to sell a house for $7 million than it is to sell a unit for $700,000. That's now flipped.
Yeah.
So you need to be watching the market, and some of the points coming back to Shane Oliver that he's made there are very, very relevant.
So he's touched on a number of things that are influencing it. One of the things he says is a combination of higher interest rates. Now, we've talked about the most recent RBA statements, so we've talked about the likelihood that we're to see more of an increase there. He's also talked about a slowdown in immigration, something that we talk about often as being a contributor to the high prices here in Sydney. And he talks about the budget changes. Based off his commentary, do you think that, firstly, there's a bit more of a correction to come if the RBA is to go up on interest rates, for example, and, the continuation of the government's property policy? And I guess ultimately, do you think if that's the case, are we likely to see a little bit more of a dip in this super cycle or, as this cycle turns around before we start to see some correction or balance?
Okay, let's pick it apart. And in fairness to Shane Oliver, we haven't spoken to him. We can only go off the comments that the Herald have attributed to him in that article. But the first point, he thinks immigration's going to back off. Last year when we did our Talking Property segment with Louis Christopher, I said to Louis, the Sydney rental market will rise 10% next year. And he said, no, the data doesn't support that. But we said, let's have a bet. We'll have lunch on it. And the reason that Louis felt the rental market wouldn't do 10% this year is because the government were backing off on immigration numbers.
Yeah.
I hold the view that the market are telling people what they want to hear around immigration and then just ploughing on with their plan regardless. So they're continuing to overshoot on their own projections on immigration. So that's the first cross there against Shane Oliver saying the super cycle is over, is that's predicated on a pullback in immigration. I don't see that happening in any deep, meaningful and structural fashion. I go back to Warren Hogan's talk after the budget that we discussed with our audience. is that he thinks the view for Australia and where Australia's headed is for a population of 90 million within 100 years.
Yeah.
And if you break that down, you've got to let a lot of people in. Natural birth rate is below the immigration rate. So you've got to do a lot of breeding or a lot of importing of people to get anywhere near those numbers.
Yeah.
So the government can't be trusted, and I'm not saying that Liberal could be trusted on the immigration issue either, which is is almost certainly feeding into the One Nation, popularity at the moment, because the public can see that the Liberal Party and the Labor Party are at one on this immigration issue.
On most issues these days, Peter, but that's a different talk.
Yeah, that's definitely a different talk. But yes, I take your point. So that's a variable there on the immigration. Then his other point there is around interest rates. So what's Shane Oliver saying in that comment, that interest rates will never be as low as they were? Interest rates are a variable that are not determined by house prices, but he's in that comment, if you believe the way the article of the Herald have characterised it, is that interest rates will never go back down, therefore the property super cycle will never come back.
Yeah.
The thing, more than anything, and this may be where Shane Oliver was getting at, you'd have to ask him, the thing he may be getting at is the structural reforms with the taxation incentives around property are not going to be reversed. Liberals won't get the mandate to reverse them. Pauline Hanson has said that if she did become Prime Minister or Kingmaker, whichever one of those it is, she would put a cap on the number of properties that can be negatively geared. So the property market has been forever restructured here, which may well very feed into the super cycle being at the end of a 30-year run.
Yeah, which, for many listeners certainly won't be a bad thing necessarily. There's plenty of people that do want to get into the property market that can't. One of the things that that he does say, though, is that regardless of the super cycle coming to an end, or that is attributed to Shane in this article, he says, though, that the property market is still sitting infinitely higher or much higher than the long-run sort of price level should have it sitting at. So, he's attributed to saying that Sydney property values are 41% above their long-run price levels. Not the highest in the country. Brisbane's up 65%, sorry. And it says here, even in Melbourne, the nation's weakest property market, values are still 25% above their long-term trend. So given that we are potentially seeing it into the cycle, and given that property prices are still, according to this article at least, over 40% higher than they realistically should be if they were to follow a normal trend, is this going to make much difference, really, for the average person trying to purchase property in Sydney?
Well, I think that comes back to employment.
Yeah.
Yeah, so that overvalued status that will still remain even after this correction that Shane Oliver's talking about, the only way that you would completely pound that out of the market is not through more, anti-property regulation, but higher unemployment.
Yeah,
which certainly nobody wants to see. And the thing about higher unemployment is you would see the RBA slashing rates at that point to get things going. And then that then takes away another one of the legs of his argument, which is higher interest rates. So, as I say, the fundamental point that the super cycle could well be over and we won't see booms of 20%, 25% a year may well be the fact, and that's not a bad thing.
Yeah.
Because let's face it, unless a property market's severely underpriced like Brisbane was in 2021, the property market should never really rise 25% like it did back in 2021 here in Sydney.
Oh, absolutely. One of the other people that's attributed in the article is an economist from KPMG, a guy called Brendan Rinn. He talks about that he thinks this cycle, he agrees that a lot of these factors or contributors are coming together and the cycle is ending, but he expects that this is going to be something of a V-shaped trajectory. Now, he's suggesting that we'll have a fall, we'll hit a trough point or whatever, an inflection point of some kind, and then due to a dearth of homes is the quote he's attributed with, but ultimately an undersupply of dwellings, we are going to see a correction back upwards again. Given we always talk about the supply and demand issue here in Sydney, do you agree with his statement? Do you think that that's going to ultimately be the trigger that turns the price correction back around?
Provided employment holds and interest rates don't rise from here. So, that's code there. He's commenting under, with the good grace of his corporate entity, KPMG there. So he's got to be restrained in the way that he speaks about government policy, where I don't. But he's essentially saying there that he doesn't believe the government on paring back immigration.
Yeah.
And they'll continue funneling too many people into the country relative to the number of dwellings available and that have been built, and that's going to be a supporting mechanism for the property market.
Yeah.
So I on that point, I lean into those comments that he's made. If we go historical on the downturns that we've seen, I've always said, as you probably heard me say in the past, the toughest downturn that I think Sydney's experienced was actually in 2018 when the Banking Royal Commission was taking place, and the banks sort of were sending a message to the government of the day: if you want 1960s style home lending, we'll give you a taste of what it looks like. And we were having financially independent people not be able to get a modest home loan to buy an investment property or a little development site to do on the side, because it was showing good value in terms of the price, but the banks just weren't letting any money go. They only let enough money go out to stop the market from a full crash. And that was a really tough market, because you'd have 10 people inspect a property on a Saturday, 3 or 4 of them would say, we're really interested, we'd call you Monday. You'd call them Monday, Tuesday, Wednesday, Thursday and Friday, and they wouldn't return any calls. And it was only when you'd bump into them ad hoc a couple of weeks later and they'd say, I don't know why, but the bank wouldn't give us the money. So that was a really tough downturn. 2018, 2008. Bob Carr did something dramatic and without warning in 2004 with the investor property tax, which really rattled the market at that point in time. And between the budget of 2000, state budget of 2004, and Morris Yema coming to power in 2006, that was a really flat market for the Sydney property market and New South Wales property market. That was only a state tax, so it wasn't national.
Yeah.
But that was a very tough environment as well. So this downturn is sort of, getting up there in terms of, tough for vendors. We've seen downturns before. This one is different and probably needs to be monitored more and maybe a little bit more concerning, because it's got structural taxation shifts and incentives, and the government have essentially played with the rule book. And when you play with the rule book, the consumers change their behaviours accordingly in the marketplace.
Well, they do. And I hate to say it, but I feel like many governments, this one in particular, don't necessarily think through the long-term projections of what they are doing either. So they mess with the rules, they tinker with the structure, thinking they'll get a short-term solution without thinking through. There's no one actually modelling for them accurately as to what's going to happen down the line and the implications of that. I want to wrap up this article just by talking a little bit about some of the government's comments. So Jim Chalmers, the Treasurer, he did talk about this being similar to other property falls in the market over the years. He says over the last 20 years, similar to 2022, 2018, as you mentioned. He made a couple of comments that I found quite interesting in this article. The first is that he said people buy homes as a long-term investment rather than focusing on a short-term easing in prices, which I find a really strange use of language. To me, that suggests that the government's saying people should be buying property with the mindset of making it easier for others to buy property, as opposed to, using the long-term tradition of actually investing in stable real estate. So I think just for me, that was a comment. There's a bit of an odd statement by Chalmers. But the bit I would love to get your thoughts on, he finishes the article by saying, housing is a long-term investment, and we continue to expect over the course of the coming years that prices will continue to rise, but more modestly than before. The statement on its own is not that troubling. It's not that big or distressing, but this is just off the back of government policy that has made significant changes to the housing market with a focus on reducing prices, increasing affordability, etc. Yet the Treasurer is here saying, well, house prices are going to continue to rise. Maybe we've just slowed that rise a little bit. To me, I'd love to get your thoughts, but to me that seems like a pretty odd position to take from a government that has been so focused on saying we are getting the prices down and keeping them down for you.
Yeah, look, they're all fair comments that you make there. There's no doubt about that. What I would say in response, just going in order of his comments there, Chalmers said the decline in value so far this year was similar to 7 previous falls in the property market that have occurred over the past 20 years. Well, besides Bob Carr's fiddling with the, inventing a tax on property investors in 2004, which absolutely rattled the market to the core and forced Morris Yema to come in on a mandate of overturning that less than 2 years later. We've never actually seen such a dramatic tax impost on the market that's changed behaviours since then until now.
Yeah.
So the reasoning for every fall is different. And yes, you knew when you were going things like the GFC that whilst it was a deep and dark event, it was all part of, a very nasty part of the cycle. COVID was unprecedented, but I took a view early that with mortgage rates at 1.99% and inflation, at 2.53%, that money was effectively free to borrow, and the banks were very loath to close anyone up. I felt pretty comfortable in saying that there would be no total meltdown. Now, after the COVID shock where it dropped 10%, it bounced back very, very quickly to be only down 5% for 2020 and never dropped again during COVID. Yeah. Such was the money that was splashed out. So this is very different, again, because the government have changed the rules, therefore they've changed the behaviours of the consumer. Now, I can't tell you how many people I have run into in the last week who've said to me, we're leaving Australia.
Yeah, wow.
Yeah, it's like we're just packing up, and we've always had a romantic notion to go and work in Europe or head up to Asia or go back to New Zealand and start a business or whatever it might be. I'm not looking for this in conversation. It's just coming to me is in my day as a suburban real estate office where people are going to the sidelines in different formats. Investors are saying, I'll invest somewhere else, I'll invest overseas, I'll hang on to my money, I'll pay down debt, I won't play in the property market. So the government can't point to previous downturns and say this is part of a normal cycle. That's laughable.
Yeah.
It's absolutely laughable to take that position. Then this is the odd part. Chalmers said people bought homes as a long-term investment rather than focused on short-term easing in prices. Well, hang on a sec. The message here all along was the family home should be for living in, and now he's saying, don't worry about the short-term pain we've imposed on you. Don't worry about the fact that we've tipped first home buyers or some of them into negative equity. This is a long-term investment.
Yeah.
Well, hang on. That's the first time you've ever related the family home as an investment. You were trying to make the primary residence a residence to live in, and now where it suits, you're trying to cut your cloth to suit your message, you're telling us it's a long-term investment, not a short-term one. Yeah. So I find that really unusual wording there from the Treasurer. And then he says, people don't make investments in housing from day to day or week to week, month to month. And so from time to time, you'll see movements in prices like these. Well, not really. He's suggesting in that comment that this is all part of a natural cycle, again, where sometimes prices go up and occasionally they come down. This is a manufactured downturn. He's trying to distance him and his government and his budget from the meltdown that's happening in property markets at the moment.
Yeah. Well, he is. He's trying to say that regardless of what people do or how they buy, this is just a natural correction, as you say.
Yeah. And then he says, housing is a long-term investment. We continue to expect over the course of the coming years that prices will continue to rise, but more modestly than before. Over the course of the coming years, prices will continue to rise. Well, I've never sold a property telling people that a property is going to rise, and nor should he, because if you look at the Brisbane property market, for example, that went 11 years without hitting fresh highs.
Yeah. Well, again, though,
my point, if the conditions are right.
No, it's true, but my point on this comment is he spent all this time, and the government have spent months talking about their whole remit to bring house prices down, keep them low, make it affordable, give everyone a fair go. It's any catchphrase that you want to use. And here he's saying, firstly, distancing themselves from their own policy, but then saying, well, actually, house prices are going to rise anyway. And if anything, maybe we just slowed it down a little bit. But we didn't actually slow it down because it's part of a natural cycle and we had nothing to do with it.
He's trying to walk both sides of the street.
Of course he is.
Yeah.
And, unfortunately, he doesn't have the capacity. Moving forward, a great article and really good to get some insight from a different, couple of perspectives, one financial and, unfortunately one governmental. I did see on social media this week, Tom Panos, who I'm sure many of our listeners, if not all of them, would know, is a very well-regarded or well-known property commentator, auctioneer, trainer. He's a bit of everything in the real estate space. He has been riding a bit of a wave of activity at the moment. And one of the things he's talked about is just the fact that there are no people turning up to bid at some of the auctions he's running. Now, I know you follow a lot of what Tom does say, and you're familiar with all of his commentary. I'd love to get your thoughts on what Tom has to say at the moment around the market conditions and whether you think he's, just projecting from an isolated segment, or has he got a pretty good take on what's actually happening across broader Sydney?
Oh, look, I think he's got a good take on what's happening out there. There's a couple of caveats as well if you just slice and dice it. His auction last Saturday, for example, was a $2.8 million property in Marylands.
Yeah. Yeah.
So I'm sure the people that live in Marylands love Marylands, and I have no problem with Marylands. But what I can tell you in any downturn, the top end of the market, whether it's the top end of Marylands or the top end of Vaucluse, is the hardest to sell in downturns. You'd rather bread and butter stuff. So that's selling it. But what we're talking about here is auctioning it.
Yeah, which is crazy at the moment.
Now, if you're talking about auctioning it, you need a multitude of buyers to fuel the bidding. And if I'm really honest, the sales that we're making at the moment, there's one, maybe two bidders if the vendor's lucky on most of them.
Yeah.
The buyers are fair-minded and they're prepared to pay current market price. They're not trying to steal it from the vendor, but they're not looking to overpay either and compensate the vendor for the environment of the day.
Yeah.
And they don't need to because they'll just move on and buy something else. So, look, I can't be certain. I was almost tempted to sort of do some further research and find out where, but I think from what I can understand over the years, a lot of Tom's auctions are west and southwest.
Yeah.
And that is much more impacted than certainly what the inner west is, which is the only market I can talk about with deep confidence at the moment. So we have a number, our listings are at 15-year highs at the moment. That's not 15-year highs for winter, even though we're still in winter. That's 15-year highs.
Yeah, wow.
That are on the books in terms of what's listed and what's coming. So I suspect that to balloon further come spring.
Yeah.
But of the properties that we're working on at the moment, and we've taken some listings over from other agents, and even the listings that we've taken over from other agents, the other agents have had offers on those properties, but the vendors don't always want to go with those offers, but the offers are there. And more than half of our stock, we have offers on it.
Yeah.
They're close, they're right, they're a little bit above, they're a little bit below what the vendors want, but they're peppering the pin. So there's no shortage of buyers out there prepared to, willing and able to buy property. And this goes back to the immigration numbers that we discussed and the housing crisis. I don't think the housing crisis has gone away. There's not enough dwellings for the number of people that live in Sydney. What we're all squabbling about here is what's the fair and real price.
Yeah.
Because you're seeing here Shane Oliver say the super cycle's over. Tom's saying no one's turned up and registered at my auction in 2 weeks. So everyone's trying to piece together this 1,000-piece jigsaw puzzle to get a clear picture, and there's no clear picture forming. But certainly one indisputable element is there's not enough dwellings in the city for the number of people that live here, and they're not building enough to compensate in the short term anyway. So, yes, if I was in Western Sydney, would I be recommending that clients auction their home? Absolutely not, or whether it's southwestern Sydney. So we've got to look at it more about not that there's no buyers in the marketplace. There's no buyers that feel compelled to turn up and bid at an auction.
Yeah. I honestly feel like too, people, and I could be wrong, and I'm sure you can correct me here, but I feel like of all the market conditions, when there is a bit of a downturn and it's a little bit of doom and gloom and it's, it's a long winter with so much uncertainty, people people never want to be on an auction bunny. People definitely don't want to be an auction bunny in the middle of winter in a miserable market when everything else feels like it's just collapsing around you. You know, the economy's on fire, the world's on fire, the whatever else. People don't want to go and be a pawn in a real estate agent's game for a property. And I think that it's for a lot of these agencies, the chickens are coming home to roost, so to a certain degree. And as we said before, like a majority of these properties should not be going to auction anyway, let alone in this market with these conditions, with just the negativity around.
Look, you're skirting around another great point there, Kieran, which is underquoting.
Yeah.
The Department of Fair Trade have clearly sent the message to real estate agents in the industry. They mean business on underquoting.
Yeah.
And I will be, I must be honest, that the amount of underquoting in the marketplace is nowhere near as bad as what it was 12, 15 months ago. So that's another reason that the auctions are under so much pressure, because as I used to say to people when they would say, why do real estate agents underquote? And it's like, because it works.
Yeah.
It creates a frenzy.
Yeah.
That's why they underquote. And then a crowd of emotional bidders turn up and the price goes up. But now that agents can't underquote to the degree that they were, it's very, very difficult to create those frenzies, particularly in this environment. So certainly the clampdown on underquoting is not the reason that the auction clearance rate is under so much pressure. And just to put some numbers around that while we're talking about auction clearance rate, if we go to SQM Research's numbers for last weekend, there were 540 auctions with a final clearance rate of 33.3%. The week before, there were 610 auctions with a clearance rate of 37.1%. The auction clearance rate in Sydney 3 weeks ago bottomed at 29.4%, for example. So I think underquoting is playing a bit of a role, or the clampdown on underquoting is playing a bit of a role in those soft clearance rates as well.
Yeah, look, I'm not surprised. It is anyone listening would be happy that the government and fair trading are taking action on this. I told you earlier, I'm helping some friends try and get a property at the moment. They're going to an auction, on the evening of this recording, interestingly. And the commentary they've been feeding back actually is that the agents are surprisingly pushing to auction, but it seems like there's no interest. They said it's a really mooted kind of environment at the moment. It's almost like some of these agencies are just resigned to push through, in their opinion, because that's what they committed to.
Well, whereas, on that auction night, your friends are going to, one of our clients is going to bid on a different property, and he has exactly the same telltale signs. Is he thinks there's no interest, but the agent, he's sticking to the line. If there will be an auction, and there's 6 in-house auctions tonight over in Marrickville.
Yeah.
And I guess, the proof will be in the pudding as to what happens there, but exactly the same sort of feeling as it feels really sluggish, feels like there's no interest, but the agent's like, we're going to auction.
Which to me is crazy. And anyone, like you say, anyone in the industry who can read any of what's happening at the moment would think this is a terrible, terrible idea. But nevertheless, we'll find out tonight, that's for sure. Look, as always, Pete, really great recap on the market. I think we are, in my opinion anyway, at least in the last 20 years, maybe we are in unprecedented times because we have a downturn that's impacted by some foreign events. It's also impacted by immigration. It's impacted by a bunch of domestic problems, supply, demand, etc. But it's also underpinned by massive, invasive government policy shift. So certainly I'll be following what happens, but I feel like we are in a bit of an unprecedented period. It's going to be interesting to see what comes from here.
Yeah, it's a very fair call. If there's structural reform, there'll be structural changes, and that's what we're seeing.
That's true. Well, look, as always, thanks for coming in, Peter. It's been really great to chat.
My pleasure. Thanks, Kieran.
Thank you, and thanks to everyone for listening to Current Market Insights. We look forward to speaking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.